The question we are asking is, do growth stocks need a bit of a reality check? Some would say it's already happening. Others would say more is required before they become more reasonable. Growth as defined by high valuations, high P multiples, because in many of these cases, and I'll present stocks later, market is given very high growth rates in perpetuity. Is that going to come under a bit of a reality check? I want to start with something macro, right? And this is interest rates, what I'm talking about. There are two knowns and one unknown. The two knowns are that global inflation is falling, is very clear. And at some point this year, interest rate hikes will stop. Global interest rates in the US, here in India, and everywhere else as well. The unknown is, once interest rate hikes stop, will rates be held high for very long periods of time, or will central banks once again cut rates to very low levels? And I think that is a $1 billion question, because equity valuations will depend on that a great deal. Now, two charts. One is the US 10-year government bond yield, all the way starting 1989 to where we are now. As you can see, I mean, a secular 3-decade decline, and now we've seen a bit of signs of life, right? And many believe that this has got more to go. This is not the end of it. The Indian government bond yield, the benchmark 10-year, is also back at where it was pre-COVID. I started this from January of 2019, and as you can see, we are almost back there as well. So interest rates, the point of this is, interest rates in that sense have normalized to a great degree. Now, why are we saying that maybe, just maybe, policymakers will follow a more orthodox policy going forward, monetary policy going forward? We had negative real interest rates all the way from 2009 onwards to 2021 when rate hike started. Inflation shock was massive. Inflation is unpopular with central banks who are mandated to bring it under control. But of course, politicians hate it as well. And now with the recent events of trying to get inflation under control via a big hammer of very sharp interest rate hikes, will central banks and policymakers allow rates to go back very quickly to very, very low levels? And that's the question we are asking. A more orthodox monetary policy, it's a big question mark. Now, low interest rates are important for equity valuations for two reasons. One, the market assumes low cost of capital for a long time, in some cases in perpetuity. And it also allows the market, as we are finding out now, to overlook potential risks to business models. Even risky, faulty business models were funded because money was cheap, which is not the case anymore. Two tables I'm going to put out now. One, large cap growth stocks, and the second is mid cap growth stocks. Now, this is not a comprehensive list, but just a sample to give you an idea of where we are at. The second column here is valuations 1 year forward in March of 2011, where they got to just before COVID, March of 2019, and where they are now. This is all 1 year forward. As you can see, I mean, I'll just focus on the third and the fourth column here. Valuations are still, except maybe Siemens on this particular plate, much high. I mean, Siemens was trading at 37 times 1 year forward. Pre-COVID, it's at 60 times. You can see it for yourself for Asian Paints, Ambuja Cements, and other names will come up. HUL, for example, United Spirits, Avenue Supermarts. Titan perhaps is the only one here, which has almost nearly come back and retraced to pre-COVID kind of levels. I'm not even getting into growth rates and projected growth rates. As we found out this week, a lot of these growth companies have seen a slowdown as well. Now, this is mid-cap growth stocks. Balkrishna Industries, Schaeffler, Havells, Page Industries, Volt. I mean, the only one here which perhaps is come back to pre-COVID is Page Industries, 52 times as compared to 54 times. And then you look at names like Voltas, Varun Beverages, Dr. Lal Pathlabs, Jubilant, L&T, etc. up on your screen. A similar kind of picture. I mean, these are well-run companies, leaders in some cases in their respective sectors. But that's not the point here. The point is, if rates don't go back to being very low, will they continue to put pressure on valuations going forward? And do these need to gradually come off a little bit more from here? Back to you.